Okay, perfect. We're back. So again, first time, two platforms, too complicated, but we're learning. So I'll introduce myself and Reena again. This is Ali Salarian, broker of record, REMAX Success Realty, and I have Reena here with me. You can introduce
Yep.
yourself.
I'm Reena Visani. I'm mortgage agent from Dominion Lending Center's Affinity Mortgage Solutions, and we're happy to be here to talk about the new changes.
Perfect. So today we are going to talk about the new rules for amortization, which was I think in September announced by the federal government, and to tackle the mortgage industry, in particular the first-time home buyer, and some of them are for the other buyers as well. There are a bunch of them, too confusing, complicated, and today here we are just to start with the introduction, a little bit, a summary, and then go through Q&A if you have any questions. So we have some agents here, we have some audience here, they can ask their own question directly, while on the both platform, the LinkedIn and Facebook, with the live stream, there is ability to chat. So you can send in the chat your questions. We have someone who's monitoring here, Spencer, and he is going to go through those questions and ask us or write it down, and we can, answer those questions as well. Uh, Earlier, we even published or we kicked off a campaign on the Facebook for someone who has a question, even to call them. We have two phones here. If someone on the phone want to call us, that's okay. And if someone will call the brokerage, I will say our phone number is 905-209-7400, 905-209-7400. And we have two extension here, 106, and the other one is 107,
104.
104.
107, sorry.
Sorry, 107 and 106. If you call the brokerage, it's right here next to us, so we can answer the questions. Okay. Um, so let's start, Reena,
Mhm.
about the summary of those rules we were talking about yesterday, actually. Uh, just summary. We don't want to go into
Yeah.
details. It's going to be too complicated.
Yeah.
Um, and meanwhile, I'll try even to put some, but I don't know the TV next to me. It shows or not, but we'll talk in summary about that, and we go about simple examples later on, and then we start to take the
Sure.
question. Yeah, Rita, go ahead, please.
So there's a couple of mortgage changes coming. We'll start with anyone that's purchasing a home and putting less than 20% down payment. Starting December 15th, I believe. Yeah, December 15th. Anyone purchasing a home with less than 20% down can have access to a 30-year amortization, which was previously 25 years. And this is available for any first-time home buyer or anyone purchasing a new build. So anyone purchasing a new build, obviously the property has to be owner-occupied or a secondary home. And the benefit of a 30-year amortization, one is a lower monthly payment and boost in purchasing power about 7%. The second rule that is pretty exciting as well, again, anyone purchasing a home less than 20% down. Previously, we could only allow a purchase of up to under $1 million. That price cap is increasing to under 1.5 million, which means that, a lower down payment is, required for that. So that's, encouraging as well for a lot of people buying. And this is available for all buyers, not just first-time home buyers. And then the third, exciting change that has happened, this occurred on November 21st. A lot of lenders are now getting on board with it, but basically when you're renewing your mortgage, you can switch to a new lender without having to go through the stress test, right? So that's another exciting change. And obviously the last one, which we we'll have more information as it comes along, but starting January 15th, you can refinance your mortgage into an insured mortgage up to 90% loan to value to add secondary suites. So this will help people, who want to have the additional rental income coming from, building these additional secondary suites. But yeah, that's pretty much the summary of it.
Too much to grabs.
I know, too much information.
Let's go one by
but
one.
let's
Let's
go
go
through
one
each
by one, and then we'll open to the question. So the most exciting, I think, for the people, especially buyer out there, is
Yes.
first-time home buyer, is affordability. And we know what happened to the
Correct.
market for the last 2 3 years. It went down, but it's not that down. So, in simple term, people having a deposit, which is not enough for the house they want to buy,
Yeah.
right? And so they end up whether changing their mind or downgrading to smaller house. That's why we have seen in the market smaller house, like single house, like towns are right now, as I'm talking to, and even a month ago, it started to be really, really doing well. So um, the first time home buyer, now there is a term called insured,
Yes.
uninsured.
Correct.
We know, you know,
Yep.
most of the audience here, they know, but most of the people out there, they don't know what's the insured and uninsured.
Yep.
So the regulation says, even the minister was the other day on the TV, she was talking about term insured and uninsured. It's like too dark for the people. So they said before up to 1 million.
Yes.
Okay, now up to 1.5 million.
Just
So
under 1
so
million.
two things is happening here, right? One, the amortization is going to go from 25 to 30 years. The other thing is, previously you could not go above 1 million if you are insured, and the term insured is when you put 20% below,
Less than
like
20%.
let's be 19%, 0.9999, that's
Yeah.
considered mandatory insurance by the industry, by us. You have to insure your mortgage, meaning you go to the insurance
Yeah.
company like CMHC, Genwinth, and Canada
Sagen,
Trust.
yeah.
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 So so before, if you had below less than 20%, you have to insure. When you go to the insurance company, they say, hey, 1 million, that's it. So what happened to you? You can't go above 1 million. Now the good news, multiple good news. First, you can go to 1.5.
Correct.
Second, you can extend the amortization up to 30
As a
years.
first, yeah.
Third, there is a tier, like 5% for the first 500,000,
Yeah.
10% for the remaining.
The
We have a
additional.
calculation for that, which Reena is going to take you to through that. But before that, that's the way I spoke to you is the real estate's easy, simple English way. I will let Reena go in details, talk about this point, one of them, and
The down payment point?
yeah, the down payment for the insured, which is we're referring to the less than 20%.
Yeah.
Please go ahead.
So the down payment on someone putting less than 20% typically is 5% of the first 500,000 plus 10% of the additional on top of the 500 and under that 1.5 million mark, right? So previously when we, before these rules, on a $1.5 million sort of home, you needed a $230,000 as down payment. And for a lot of people, that's hard to save up, right? In terms of, just takes a while to save that, $230,000 up. Now, with these new rules, the maximum down payment you would need is under 125,000. So that helps, buyers get into the market, quicker instead of having to wait. So like in terms of down payment on a 1 million, now you need is 75,000.
You have a
Right.
nice table if you can go through that table.
Yeah,
So
sure.
to give a live example, that's very important. Again, what we talk here might complicate things, but when we give you the example, and I think most of the people they will fit in that example. We have that table.
Yeah.
So if you start Rena, so Rena will give you the amount of the purchase, the down payment before and after required. So the amount is the same before and after required, and the amortization before and after, monthly payment before and after, and even the insurance premium, the premium before, because that's another thing people they don't know, that your premium is going to go up.
Yeah.
And your interest is going to go up because your amortization is going to go 5 years more.
Yeah.
So Rena will go through one by one, like I think you have 4 or 5 at least
Yeah.
examples, so you can start from the $1 million, right? If you
Yeah.
want to go, and if it's
So-
up to you if you want to go more, or maybe
Yeah.
1, 2, 3 example, maybe enough.
I'll take a
Yeah.
couple of examples just to give you an idea, right, in terms of what's required on a down payment prior to these rules and after to these rules, as well as what sort of income, household income we're looking at in a monthly payment, and as well as the mortgage default insurance premium that you're looking. So the way the mortgage default insurance premium works is that it's typically added to your mortgage, and the premium is based on obviously the amount of down payment that you're putting. If you are putting the minimum down payment, there's a higher premium. As you add more, the premium decreases, right? So typically, if you are buying a $1 million home, prior to these rules, you would need a $200,000 as a down payment. Income required, a household income required on this would be about $160,000. And a payment, considering, today's fixed rates, let's say about at 4.39%, we're taking a 3-year fixed, 25-year AM, you're looking at about $4,400 monthly payment. Post these rules, if you wanted to, obviously put a lesser down payment, the minimum down payment would be required to $75,000. Household income is about $206,000. The premium on this is $37,000, and the monthly payment on this is about $5,100.
Reena, I'll stop you here. I
Yes.
see a big gap. Look at
Yeah.
200,000 and 75,000 down payment.
Yeah.
Not even more than double, right? So
Exactly.
that's a big relief. That's what we say really is going to help you in affordability. So now, just previously means today.
Yeah.
Tomorrow is going to be different. So today you are required on $1 million to bring $200,000 down payment if you are below the insured, which is below 20%. Tomorrow, starting tomorrow, I think 12 a.m. at
Yeah.
night, right? Tomorrow, you're gonna be 75,000, so 125,000 less. Imagine that kind of big changes happening in our industry. Hopefully for longer
Yeah.
time, people don't understand. Unfortunately, some agents and our industry president, they don't understand, and it's very good. That's why we have this. I know there are a lot of videos out there, a lot of article and everything. We are here to break it down really, really, and we are live here. Anyone can talk to us and go through examples. So look at the other thing. Look at um, the income required. Income required is going up a bit, right? From 162 to 200,000, right? Is that correct?
Yes, it does.
Okay,
But
40,000.
in relevance, if you look at it, right, somebody that's, making it in the higher bracket, their take-home income is going to, obviously be a lot less, which kind of deters them from saving up that full 20% that they need, right? So here, even though the cost of borrowing is a little higher, but it gets you in the market quicker with a lesser down payment.
Yeah, but again, income goes higher. Now the other thing is the monthly down payment from 4,400 to 5,100. It's like 700 more, right?
Yeah.
But again, if your income works, TDS, GDS, which is a term we
Yes.
use in this industry, works well, then this is what you are getting. Again, the interest is going to be higher. The insurance premium is going to be higher on the downside of it. But the good side side of it, I'm always looking at the full part of the cup. I don't look at the empty part. The full is from 200 to 75. The downside is higher interest. You're going to pay more amount of interest over the 30 years because it's 5 years more, and then you have the monthly payment, right? You want to carry on and go on
let's go on
another example? Yeah.
Let's do the 1.2. So on a 1.2, previously you would need a down payment of 240,000. Your monthly payment on that would be about 5,300. Now, as per the new rules, the minimum down payment you require is 95,000, and the difference in payment would be about 6,100 on that. Insurance premium on that would be about 44,200, and that's based on the minimum down payment.
Reena, can you explain the insurance premium? They get 44,000. It's too big amount.
Yeah.
How it works? There is a HST part of it, and there is the premium itself. I think the premiums goes
It's
and
the
get
premium.
amortized, right? Can you
Yeah.
explain that to them?
Yeah.
please?
So if you are putting the minimum down payment, the premium is typically 4% of the loan amount that you're taking, which is tacked onto your mortgage. So let's say if it's you're taking an 800,000 mortgage, right? That 4% premium will be added to that 800,000 mortgage, and you're paying that premium with the loan amount that you're taking over the life of your loan. So in this case, it's your amortization, right? So if you are putting the 10% down, I believe it's about 3.6%. So anywhere from 10 to 15. And then obviously, as you're under the 20% mark, it's about 2.4%.
Okay, perfect. So I don't think we need to go through more and more example.
Yeah.
Let's move to the second point.
Sure.
Which is the amortization we spoke about, and then we have sorry, we spoke about the insurance, sorry, the insured and uninsured, okay, and
Yeah.
the amortization. We covered that as well. So 2 points in one. And now we have something else called stress test.
Hmm.
No, that's for all buyers. But there's one thing to do with the first time home buyer as well. So the uninsured and insured, the amortization, right?
Hmm.
And there was one point I'm trying to find out. Let's move to the stress test. We'll come back to this. So the stress test elimination for switches on conventional
So
mortgages
uninsured,
to
basically. When
uninsured
you
basis.
purchased
Yeah.
a first home without 20% down payment, that's what's an uninsured mortgage. So you're not obtaining the mortgage default insurance premium, because your down payment is 20% or greater. Now, as of November 21st, a lot of lenders are now coming on board where someone that is coming up for renewal, so your mortgage is maturing and you're done with that lender, can now switch to a new lender, without having to go through the stress test. Now, what the stress test is, basically, when we qualify you for your mortgage, we're qualifying you at a higher benchmark than what the contract rate that you're getting. The whole point of this stress test in place is to see that you can maintain your payments when and if the rates do decide to go up. So the stress test, as of now, is basically we qualify you either at 5.25% or your contract rate plus 2%, whichever is greater. Now, with renewals, because the stress test is removed, right, we would be qualifying you without this benchmark in place. So basically at your contract rate. What that basically means, it helps people that are renewing their mortgage to switch to a new lender easily, obtain better rates, shop around, save money. At present, right now with the stress test, it's hard for people to, they're stuck to their bank because they're not able to move easily to a new lender and shop around because of this hurdle in price. So this is a great, for anyone that has a renewals coming up, it's a great transition.
Perfect. So let's put it in a simple terms. If I have a mortgage right now and it's maturing,
Yes,
if I stick with the same lender, right, there is no stress test.
correct.
Actually, there is no documentation,
No,
even
it's a straight
nothing, right?
renewal.
This is what happens. Somebody comes and want to, but if I decided to go with different lender because maybe better rate, better term, now
You have to
that lender
requalify.
will take my application like brand new, and they do, of course, they require documents, income, and everything. On the top of that, the stress test,
Yeah.
right? Like first time I'm applying. So the new rules is like continuation. No matter which lender you are dealing with, it's continuation. In fact, I think the government looked at the monopoly of lenders. If they want to get a client and that they want that client to stick with them, they give them now. They give all lenders in the market or the consumer best rate, switch lenders, and all of that.
Yeah.
This is something new in the industry. I
Yeah.
think for a long time.
And when you
Yeah.
do, so what that, I mean, when it comes to switching, there is a criteria for it. Your loan amount cannot change. It has to be as per what you're switching. So exact, same amount. Your amortization
Mhm.
has to remain the same.
Okay.
And then your mortgage also must come from a federally regulated institution. So um, as per OSFI, so that's a huge criteria.
So if I'm asking more money, that's
That's
considered.
considered a refund. You have to go
Refund.
back through the stress test.
Okay.
Yes.
Oh, that's a big thing because most of
Yes.
us, I mean, not most, some of us, when we switch lenders, we're looking for more money, refinance, get more equity out. Maybe we do it. So that's very important. But if when it just do it as continuation, and the only reason I'm switching the lender because some reason I'm not happy with them, could be obviously mostly the interest rate.
Yeah.
Somebody else is giving me better interest rate. If I'm continuing that and switching, they still require income documents and everything, or
You still require income documents to switch to a new lender. The
Mhm.
only thing is you're not stress tested at a
Okay.
higher rate.
Because it's fair. The new lender wouldn't know about your income and all of this, so they should ask for
Yes.
that.
Yeah.
Okay, that's clear. So there is one more thing to do with the 5% for the first time home buyer.
Mm-hmm.
and there is something to do with not necessarily the first time home buyer, even the if you buy from a builder pre-construction,
Yes.
right? So there is something new came here as well. Can you explain that, please?
Yeah, so anyone purchasing a new build um, and putting less than 20% down, you can also go up to a 30-year amortization, where as long as, the person buying it is either occupying the home or it's a secondary home. It cannot be a rental, obviously. But yeah, so that's also a new sort of rule that's come out, which also promotes, the construction market as well, the pre-construction market to people.
So this is for pre-sale, pre-construction market. So
Correct.
whether I'm a first-time home buyer or repeated buyer, investor in this way, but
Yes.
investor here, I have to be, I
You have to be
pause.
careful.
I
Yeah.
have to be careful because I can't, if I rent it, I can't go, I can't
No.
go with the 35% and 30 years
No, you
amortization, right?
cannot.
So not an investor. So let's say whether I'm buying from as a first-time home buyer or repeated buyer,
Repeated buyer.
means I sold my
Yeah.
house, I got into a pre-construction, right?
Correct.
Let's put it this way. So I can go with 5%
Mhm.
and I can go 30 years amortization. Is that correct?
That's right. Yep.
So that's another thing for the first-time home buyer and repeated buyer. But you have to be very careful here when I say repeated buyer, because most of the people buying from pre-construction are investor. So two things you are getting here: 5% down payment, 30 years amortization. I know now there is a complication a little bit with the builder because some builders they take 20% down, right?
Yeah.
How
Yeah.
that works, I don't know
Yeah.
that technicality.
Yeah.
But I have seen recently some builders they take 5%, 10%.
They're going to be changing that criteria to
Yeah.
match or promote this.
I know, Reena, before we come here, we talk, you disclosed to me there is a lot of complication, a lot of things to be done from the industry point of view, lenders, to change the system with what the government announced back in September. And even some lenders, they think September till December 15 is not good enough time to, from their back end. There is a lot
Yeah.
of policy, there is a lot of system. I used to be a banker. I know what I'm talking about. So that's why you think even there might be delay from the industry, delay in terms of you call any of the banks, say, hey, the new rule says this and that, I'm applying. Oh, well, wait a bit, we are not ready to go. Doesn't mean we are rejecting you, we don't want you, but we are not ready to go. Maybe they will soon in the future, or yeah, now we are ready to, they call it the product, right?
Yes.
This product is ready to go and serve you, Mr. or Mrs. Borrower. Okay.
Yeah.
One more thing is about the LTV, 90% LTV for insured refinance.
Yes.
Did we cover this?
I briefly mentioned it in the beginning, but I can definitely go over that again. So this is, we're still getting a lot of information on this, but they had eliminated this product. I believe it was 2016, but they brought it back. But it's for anyone that owns an existing home, and they're looking to refinance their home. You can refinance under the insured. Again, it has to be an insured product, up to 90% loan to value. And the funds being used from the refinance has to be used to add a secondary unit. So what I mean by a secondary unit, it's something you can rent out long term, right? And it could be like, a basement or a laneway house. So that's what this program is. We don't have much details in terms of, in terms of how the construction funds are going to be dispersed by lenders, but this is pretty exciting as well. And you can also go up to a 30-year amortization on this, as long as the purchase price or the value of the home does not exceed $2 million.
Okay.
And that's inclusive of the renos that you're doing to add this secondary unit.
Okay. So let's put
as
it in,
complete. Basically.
This is put it in reality. So I have a house, I have a basement, potentially unfinished basement, okay, or finished basement is bad shape, okay.
Yeah.
I might need a separate interest to construct and put a kitchen, whatever. Consider things are legal here, right?
Yeah.
Then I go to the lenders, to the banks here, and I say I want to borrow in order. Actually, you're borrowing a money. Let's say it costs you 100,000. You want 100,000 to finish that basement and make it 100% legal basement and everything. We can be rent out and add an income. So they will do an appraisal on your house.
Absolutely.
Let's say your house worth, we said up to 2 million.
Yeah. So
Okay.
they'll do an appraisal before to see what the value is. And after completion of the renovations, they'll do another appraisal to see what the appraised value with the renovations comes up.
So let's say whatever is the appraisal, let's say the appraisal is let's say million, to make it very simple, $1 million appraisal. Then up to 90% they will finance. Meaning, if my debt is, let's say I have 70% debt, like 700,000.
Right.
Now I have 200,000 available, something like that, 20%. Now I can go borrow that money and take it from the bank as a line of credit, probably.
It's going to be, so it could be cash and equity, right? So like a refinance, you can either get it as, cash in hand to do the renovations, right? Or you can get a HELOC. It's up to you, like how you
because
want it.
I came from corporate commercial banking. I'm trying to think the way you said, the construction loan is different.
Yes.
So that you pay, or you bring an invoice to the bank pay, and then they do some sort of inspection in different stages.
Yeah.
Very complicated. To do it commercially, I think it's easy. We used to do it. There is a mechanism a long time ago in the market.
Yeah.
But to go for individuals, retail, it's really headache. So what I'm imagining is going to be in a way of line of credit or HELOC, right?
Usually, cash.
So you have it there. You take that money. You pay your trades, your contractor. But I believe, as a banker, again, you will put one more condition at the end, that we're going to send an appraisal guy who is going to act as an inspector. Will look, hey, did you did something good? Did you did something worth 100,000? Or you brought a cheap guy for 20,000? He took it, right? So this kind of building the mechanism, everything is something the banks really need. They need the time. From September to today, they can't do it. So this product, in my personal opinion, is going to be delayed by the lenders till maybe a couple of months from now, or somewhere maybe second quarter of 2025, or maybe third quarter, which is very, very good, because guess what? A lot of people having high mortgage on them, and they want additional income. Well, they have a basement. I have a basement in my house, but I need an entrance, and I need to put some stuff to make it livable, because it costs me money. My estimation, easily $50,000, but I don't have that money. Now there is a chance you go and borrow that money, and it's going to help the buyers. Now we are not talking about first time home buyer. Any homeowner here, right?
Yes.
Okay.
As long as you're occupying one of the units, so you can build up to 4 units, right, under this program. So technically you're supposed to be, or your relative or whatever has to be occupying one of the units, and you can build 3 additional units on your property.
Yeah, so this is back to the classic. It's like refinance. I'm refinancing. If you remember back then, people are refinancing, getting equity out, buying a new property, or getting out, renovating their own property, or getting money out and doing the basement and everything. But this has rules and mechanism, and the LTV, I think, is the biggest
higher.
Thing. Yeah, before it was 80.
So you can refinance up to 80%.
Before.
Yeah, as of still, right? So you can still refinance up to 80%.
Still till today, but tomorrow is going to be different.
It's under this program. If you want to add that additional secondary unit, then you can go up to 90% LTV.
Sorry to correct. It says January 15th.
Exactly.
Reason why? Because it takes time. I know, I used to be a banker, so they didn't put it tomorrow. So it's going to be January 15th. And even I suspect the bank will be ready for that. But I believe big ones are ready, always ready. Okay. What else, Reena, missed here? We missed something. Stressed. We want to finish and go for the Q&A. I think we covered the 30 years amortization. We covered the big.
Did you want to go over the criteria of what, a first-time home buyer is considered? I think a lot of, my clients have that question. Let's say if one person is a first-time home buyer, the other person isn't, can they still be considered a first-time home buyer?
That is the biggest question I'm asked when I deal with the consumer out there. They says, me, my spouse, as per the old rules, I know, lawyer told me, they said 2 things. If you have a property anywhere on this planet Earth, obviously not in Mars, but planet Earth, you are not considered first-time home buyer. So if you disclose that, you're supposed to disclose that, you are not considered. Number 2, if one of the applicants or borrower is not a first-time home buyer, then unfortunately the second one is not considered first-time home buyer.
No,
existing rules, I believe. Existing.
So I'll go over.
Correct me if I'm wrong.
Yeah, so I'll go over what it's considered to be a first-time home buyer. 1, the borrower, whoever the borrowers are, have never purchased a home. So that's one criteria.
If one of them did and the other one, the house.
Well, if both of them haven't. But if one of them did and they still haven't lived in that, house or ever owned a primary house, then they can still buy.
Lived means they moved and lived there.
No. So like if they've never owned a home, right? That means they've never purchased a home in their life. They're still considered a first-time home buyer, or somebody that hasn't owned a home in the last 4 years, right? And has never occupied a primary residence is still considered a first-time home buyer.
Okay, let's put it an example.
Okay. Let's say someone's going to rent.
Yeah. No,
right?
let's put it. We have a house. We are a couple. Okay?
Correct.
And we sold
Yeah.
ours.
Yeah.
Okay. Or we still have it, but was under one of us name. Like we were not married. Now we are married.
Yeah.
Okay. But we lived in that house.
Yeah.
Okay.
You're not
As a couple.
Yeah.
Now I want to take advantage of this rules and go back. Whether having that house or selling that house or renting that house, I want to go and say I'm first-time home buyer. Okay. Because of the new rules. Would that work?
No, you can't, because you've occupied that house in the last. There's a
4
time
years.
for it.
Okay.
Exactly. You're
But if
still
I
not
go above the
considered.
4 years, it's okay, right?
You're okay. So let's say if you go and sell your house 4 years later, right? You're renting for the next 4 years,
Mhm.
right? And you want to go buy a house after that 4 or 5 year mark, then, and your spouse also hasn't lived in, their primary residence, or your common law partner, then you do still go back to that first time home buyer rule.
That's sweet. So
Yeah.
4 years, that's important.
That's the mark. Exactly.
Then we consider first time home buyer, but even I can rent that one. We can rent that one, right?
Sorry?
We can like rent that property with if we have a
No,
property.
you can't own that house. That's what I'm trying to
Oh,
say.
we cannot own.
No.
So we have to dispose, get rid of that house.
Exactly.
Okay.
Sell it. That's it. Yeah. Then
That-
you're considered.
that's what the
If
new
you
rules
still
is.
own that house and you're renting it out, then you're not considered a first time home buyer anymore.
Even if we don't live in it anymore.
Even if you don't.
After 4
Yeah,
years.
Exactly.
Okay, that's
Yeah.
what the new rules,
Yeah.
right?
Yeah.
Okay, a bit confusing for me, but this is clear now.
Yeah. But as long as one person is a first time home buyer, right? And let's say a parent buying for their child or something, right? And the child is moving in, then you can still be considered a first time home buyer.
Okay. When we say a first-time home buyer, there's two things. One is the amortization goes 30 years. The other one is the 5% down payment. Is that those for the first-time home? Oh, sorry, the government rebate. I forgot about that. The property tax rebate, not the property, the land transfer rebate, which is
Yeah.
4,000 something.
Yeah.
So that is only for first-time home buyer.
That is only for first time home buyers. Exactly. So
So-
you can never have owned a home anywhere in the world. Like if you have, back home, a lot of, new to Canada, people come here, Canadians, immigrants or whatever. You wouldn't be considered a first time home buyer under that rule.
But here I
That
see,
specific
let's
rule.
clarify this. So we have something to do with the land transfer, something to do with the lenders. The new rules talking about the lenders, not the land
Not
transfer.
the land transfer.
So land
tax.
transfer still exists like all rules. You just said it
Correct.
right now.
Yes.
Okay. So we are not mixing out between two. To be clear, so the existing rules of land transfer, which is accredited 4,000 something for first-time home buyer, you have to be both first-time home buyer. Not owning anything, not having whatever we said is not applicable anywhere on this planet Earth. But when it comes to for lending rules, what Reena just mentioned is going to apply. Is going to be applicable starting from
December 15th.
December 15, right?
Correct.
Okay.
Yeah.
Anything else we miss here before we go to
I think
Q&A?
that's it.
Okay. I think we are done from our end, and now we have audience here. We have online. I don't know, Spencer, if you can monitor online. Anyone's send anything, you can ask the question on their behalf, if you don't mind, on the both platform. And at the same time, we can start from here, from whoever is in this place. Yeah, please go ahead. What I suggest, if anyone has a question, so we have a hot seat here. We're gonna move this to the hot seat. You come close in order to have the audio very clear, if you don't mind. Yeah. And you can be seen now.
Yeah, hi.
Hi.
Yeah, my
Yeah.
question is, I have a client.
Okay.
He's actually just like he turned 18 last year. He doesn't have problem with the down payment. His like parent gave him the down payment, but he doesn't have any credit. He turned 18.
Yeah.
So how we can deal with this situation in terms of financing?
I mean, in terms of financing, the best way I would probably recommend is maybe if you can get like a co-signer, like a parent to come on title that can help him, because he doesn't have established credit, right? So that
Right.
will help in terms of strengthening his application, right? So typically a cosigner is typically needed if somebody doesn't have credit or income. I'm sure, like that helps in terms of, qualifying and making your application a little stronger. So typically if his parent can come on to help support the application, in terms of credit especially, right? That's what I would recommend.
And the cosigner has to be first home buyer, or would that
No.
affect on the application?
No, it shouldn't, right? Because he's still a first-time home buyer. He's still
Right.
considered he's never owned a home, right?
Even if their parent put their name with him,
Yeah.
so it
They
won't affect.
exactly.
Okay.
Yeah. As long as one person on title is a first-time home, you're still eligible.
Okay.
Yeah.
And would be, I'm not sure how difficult it is to get him approved for the mortgage. So
Yes.
do you think it's gonna be like do you have any kind of this a situation before?
Yeah, so a lot of people, like young buyers that are looking to buy, right? Typically, they don't have enough credit established, or they're younger in their profession and stuff, right? So it really depends on the whole application and the strength of the application as a whole, right? So typically, we don't just look at your credit, we look at the down payment. We look at the person's income, how long they've been in that, employment for, all that stuff, right? But when credit is also one of the bigger components, right, and there's lack of it, right, we typically want to see if somebody else can be brought on board to add to the application to help strengthen their
Just
mortgage.
when you are 10 and 19 years old, they need a guarantor.
You don't have a
Right.
lot
Yeah,
of
just
credit.
the
You don't
same-
have
same
history.
concept, right?
Okay.
Yeah. Cosigner or guarantor, yeah.
Okay. Thank you.
No
So
worries.
let's focus more on related to this, the changes. I mean, that's a good case. Thank you, Ali. But it's a general case. I don't know how much with the new rules and regulations, but more related to what today we spoke to. That's it's I think better. We
Yeah.
can always ask any question. Reena is available.
Yeah.
Any mortgage or lender you're dealing with, I think they are more enough than capable to take care of that. Yes, Murad, if you want to come closer here, you don't mind?
No, yeah, sorry.
For the microphone.
Just continuation. Sorry.
Extend it a bit.
Yeah, just
About yourself. Yeah.
continuation what Ali asked a question. I wasn't clear about that because what he's saying, when you're adding a cosigner, means he's in part of the title, right?
Correct.
So they're joint considered ownership of that house. So anyone is not a first home buyer. If there is one first home buyer, it would be considered as first home buyer. Is that what
Yeah,
you're
so
saying?
as long as one person, meets the criteria, they've never owned a home before, or in the last, 4 years or whatever, they haven't, ever occupied that home, right? They're still considered a first-time home buyer. So in this case, the child is still a first-time home buyer
How come it doesn't apply for husband and wife?
because they've lived in the property together. This is a parent and a child.
Okay, I'll just give you a scenario of
Sure.
a client of mine. For the first home buyer, they had a home like back home, and now there is political unrest, so they don't have that home. They don't have access to that home.
Okay.
Still, it's in the court. So it was under the name of the husband, not the wife.
But that's back home, right?
That's back home. Who can? I'm trying to be facetious here. Who can really verify that they were living together, not living together, and so on?
Yeah.
So when they come here, can they claim that actually the husband only owned the home and they haven't lived in that home, even though
Yeah.
they weren't married at that time?
So that rule that you're referring to, where you can never own, if you've never owned a home anywhere in the world,
Yeah.
It's more applied to your land transfer tax. This is very similar to, how when you're withdrawing your RSPs as a first-time home buyer.
Okay.
The criteria is a little different. So you would still be considered a first-time home buyer in Canada, right?
Mhm.
And you would still be able to be eligible for this.
Okay. So I didn't know.
Yeah.
So
It's more of a legal, I would say, lawyer.
So remember, Murad, you have two aspects of it. Are you asking from lender perspective of the new change?
Yeah.
Or you're asking for land transfer rebate? Which one? You're
Land transfer
concerned?
rebate, let's say.
Yeah, land transfer rebate. Then who's verifying and all of that? The rule of thumb in this country is
Typically,
You
as per
disclose,
that rule, a
you don't
first-time
disclose.
home buyer is not eligible if you've owned a property anywhere in the world, as per the land
Yeah.
transfer tax.
And it's
Okay.
all about disclosure. Verification, I would say it's free.
So disclosure with the lawyer or disclosure when he comes into the CRA?
With the lawyer, because that's
lawyer.
part
There's
of your
affidavit,
closing
right?
costs,
Okay, so but they
right?
cannot verify to the CRA that actually
There
when
is
he
an
came in,
affidavit you sign.
just he has signed affidavit, and
I've
he will be
seen
he'll be responsible for that or liable for it.
Yeah, well, he can't claim it, right? So.
Okay.
Remember, the lawyer in real estate transaction, they're multi-representing, so they represent the lender as well the client. Don't ask me how, but so when you talk to them, disclose, you sign all legal documents, you're telling the lender that I'm first-time home buyer, right? Affidavit, it's a legal piece of paper. If anything found later on, that can be used against the borrower in the court. But again, the mechanism to verify overseas, to be very, very honest, it's really, really hard to do that, okay? Unless one day wife and husband had a fight and one goes to the government and says,
Yeah.
hey, by the way, he owns a house out there.
Okay.
So
I got the point.
things happen, but disclosure is,
There's a little gray area between the first-time home buyer criteria under land transfer tax and under purchasing a home in Canada, right? So
Okay.
it's, yeah.
from the lender perspective, what we said today outlay that for what benefits you get, so those things, that's different than the rebate. There's two things
Yeah.
here, right?
Yeah.
Another thing is you're still considered a first-time home buyer if you're going through separation as well. So that applies to you as well. On, the home buyer plan, if someone's going through a separation or a divorce,
Mhm.
you're back to being a first-time home buyer under this
Okay,
criteria.
that's something new for me, but
Yeah.
not
Okay.
the rebate from the government.
No, not
Okay,
the
so
rebate.
two things we have to distinguish
Not the
between them,
rebate.
right? Okay, that's something new to know.
Okay. Thank you.
All right, thank
All
you.
right.
Anyone else? We want more questions related directly to those what we said today. Is that clear? You made it very clear. I'm still confused, right? Yes, sir.
That's okay. It's all related.
Hi, Reena, how are you?
Hi.
So I have a buyer who might be 100% my first time buyer, and their combined income is almost 130, 140 max,
Okay.
and they're willing to buy like max 700,000 house.
Okay.
So the first, as you mentioned, like for the first 500, they have to pay 5%, and the remaining like 10%, whatever.
Correct.
So what is the stress test? I believe the stress doesn't apply on that.
It does. So I'll tell you what the stress test applies on. It applies on purchases. It applies on refinances. And yeah, so that's pretty much what it applies on,
Okay.
right? So if you are purchasing a home, that stress test always applies.
Okay.
So they would be subject to that. So it would be basically whatever their contract rate plus 2%
Mhm.
is what we would qualify them at, right? So
But in the meeting, we discussed like the stress test would not be applied after sometime like in January somewhere.
no, so the stress test, that is only for someone that has that's switching their existing mortgage. You already
Okay.
own a home,
Mhm.
you have a mortgage on it, and you're looking to switch it to a new lender when
Okay.
your mortgage comes up for renewal.
Okay.
That's for those mortgages that don't have to go through the
Mhm.
the stress test.
Okay.
Yeah. Yeah.
One more thing,
Yes.
like my wife and I had like long time ago the house we combined. So now last 7-8 years, I'm like the house which I'm living only under my title like under my name.
Okay.
So if my wife wanna buy other house, she
Yeah.
would be first time buyer.
No, she wouldn't because she's living in the same house
Same
as you.
house, okay.
Exactly. She wouldn't be considered a first
I have
time.
to change the address then.
So unless you're 4 years, you 4 years living there,
Yeah.
and you moved out,
Yeah.
or you intend to move out, then your rule
Then
applies,
you
right?
would. As long as you have not occupied your
And
primary
you don't need to
residence in
sell
the
the
last 4.
previous house.
No,
right?
you don't.
Yeah, so you need so 4 years you move out. You have to prove. How, don't ask me. I'm not a lawyer. How to prove that? But moving out mean you buying a new house because you want to move to that house, and you did 4 years together in that house, and
Okay.
now you want to rent it out. Actually, it's like a plan for the people.
Mhm.
Like
Yeah.
it's a really good plan and really good break. Right.
And the other thing, I think the minimum down payment, a lot of people are under the assumption that you can only put the less than 20% down if you're a first-time home buyer. That's not true. So if you are owning another home right now and you want to move into a bigger home, but you don't have the down payment saved up, you can still put the minimum down payment on that new home, right? And let's say you're going to rent out your existing home. And you don't need to have that 20% down if you don't have it. So that's another thing I want to point out as well. Which a lot of people, have that misconception. Only first-time home buyers can only put less than 20%.
One thing that's clarified, we talk with the clients all over the day. Oh, the new rule says 5% on first-time home buyer. We're forgetting something called TDS, GDS. I will let Reena explain that. Qualification.
Yeah.
Qualification is the first thing you start from. Doesn't mean anyone is first-time home buyer is going to put 5%. He's going to get the house.
Okay.
We'll look at the income. So Reena, we it's very important to explain this point because we keep hearing this. I'm sure Anwar, everyone's getting. So can you explain about TDS and GDS?
Yeah, so your qualification is based on your debt to income ratios, right? How much you can qualify based on your gross annual household income and versus how much you can carry the debt of the house along with the other debts that you currently have. So it could be like a car loan, it could be, I don't know, line of credit or whatever, right? So we're only allowed to go up to a certain threshold in terms of ratios. So gross debt service ratios cannot be more than 39%. And total debt.
39% insured and uninsured, right?
No, I mean
below 20, above 20.
Insured has strict ratio, like we can't go over,
So below
right?
20. Very strict.
Below 39, so it cannot be over 39.
So below 20% down payment is very strict.
Yes, exactly.
Above is below.
I mean, yeah, on exception, you have to have a strong file. If you have larger down payment, you can get away with.
And the reason
higher
why
than
because
that.
putting more money equity down there.
Yeah,
Okay, so
like it has to be a strong
That
application.
is GDS.
GDS. That was
The
TDS.
gross.
Yeah, GDS. And then the total debt service ratio is how much you can carry over, with your total household income as a percentage of the total borrowing cost. So it's your house, including any external debts that you have. So that we cannot go over 44 if you are putting less than 20% down.
Okay.
So.
Okay, so that's very important to know because again, many people come with the same question. Oh, 5%, I'm first-time home buyer. My friend, you have to look at your income. Let me give an example. If you're making 10,000, why this exists as a banker, I'm telling you. If you make 10,000 and your mortgage end up 5,000, if the rules, the TDS, GDS, I don't know what's the ratio, allows you, that's okay. But if you make 10,000 still and your mortgage is 7,000, bank won't give you. How are you going to survive? With 3,000, you have kids, family, gas, car, life. So there are rules and regulations when it comes to the banks. Banks here is not to give you the money and put you in a trouble. Doesn't want that.
Correct.
Bank doesn't plan a trouble to tomorrow go foreclosure. That's why we don't have in Canada under the Canadian rules and regulations of bankers. As a banker, again, coming from different system, banks are not in a position to lend you money, put you in trouble. Bank, they want to avoid the trouble in the first place. Of course, give you the money and make sure you can pay that money back. That's why we have the strict rules about the down payment, insured, everything. One of the most beautiful system I've seen, honestly, when it comes to the lending and all of these things in the Canadian market, right? So that is very important. So when clients ask you about, or anyone says, new rules for us, 5%, right away, go to his income, right?
Yeah.
It's very important. Like, I don't want people being angry. Okay. So thanks.
Ollie, actually, I wanted to ask you a question, right? I know we're talking a lot about mortgage, but how do you think this is going to impact the real estate market with this new rules coming up? Like, I know you're seeing right now at a certain price point, it's a harder barrier to entry for a lot of people.
In fact, I am planning after I finish from the question, we talk to the audience.
Yes.
The realtors at an audience, not the consumer. Right now, mostly consumer, right? The question. So how this will turn out with the real estate for the realtors and the industry, in my opinion, like projection again. Everything is projected here. So I'm already done.
Yep.
Thank you, Anwar.
Thank you.
I think Danny,
I was going to ask the same question she just said.
Oh, great.
But that's,
Now, so we go to
The lights aren't
the messages, to the text. Spencer, are you ready there?
There's a few questions.
Please.
I don't think you're good with questions that don't necessarily relate to the new mortgage rules. or
I mean, let's start with the mortgage rules, and after that, if anything else, again, we are talking about mortgages here, not about anything else, right?
yeah?
I mean, real estate in general. I mean, some realtor they may ask realtor questions. It's
Yeah.
okay.
This James Camaro asked, "Where do you see rates in 2025? My mortgage is 4,500. It's insane."
That's a good question. I mean, right now what we're seeing is variable rates. I mean, if you were to compare the two, the difference between the two right now is not that much between a 3-year fixed and a 5-year variable, right? In terms of how the variable rates are obviously impacted is when the Bank of Canada reduces their overnight lending rate. That's when, the prime rate goes up or down, and that affects only variable mortgages or somebody with a HELOC. Fixed rates are typically, they're tied to how the government bond yields are doing, and that usually is impacted when it goes up or down is based on, a lot of economic factors, inflation, job report, what's happening in the US. And the trend that we're currently seeing at the moment, especially, I mean, we all know that Trump is coming into power. So, the bond yields have kind of reacted to that, are now in an upward, motion, like where I see them landing. I think in terms of fixed rates, 2025, you're probably looking at, higher 3% or 4% still, right? Depending on obviously, what happens with Trump coming into power, if, the whole tariff thing comes into play and all that stuff. Variable rate, again, the market is predicting another 75 basis points cut. So that would put us at currently the overnight lending rate is sitting at 3.25%, and that would bring it down to 2.5. Again, this is just,
The plan.
predictions.
Yeah,
Yeah.
the plan.
So
So,
I think,
in a simple term, in my opinion, there is two different mechanism of when we talk about the rate. So you have the fixed and you have the variable. Now, I would say everyone has to have an outlook. An outlook is based on what information we have from a professional like economists, some like knowledgeable realtor, industry bankers, where they see where the rate goes based on the economy performance. Because at the first place, we have to understand why the Bank of Canada, again, let me clarify one thing. Canada is a stand-alone economy. This has nothing to do with the US, but it gets affected, right?
Yeah.
So standalone economy, they have their own decision. The governor of Bank of Canada decides based on the economy performance in Canada and Canada only. Doesn't look at across the border. Now, I know we'll talk about what's tariff and all of that. So the plan is, if you follow the news and follow Bank of Canada, is, as Reena mentions, 2.5, the Bank of Canada rate. Right now we're 3.25.
2.5. Yeah.
We were how? We are 4.75.
Oh yeah.
So we reached almost 5, if not 5. Now we are 3.25. Just do the math. How much we gone down? And we're going to go further down as per the plan by end of 2025. There are indicators that they look at the at inflation, number one. That's the main factor. They look at the unemployment rate and other things, and they go carefully. They go carefully. So whether it's 50 bips, 25 bips, or no cut at all, or 15 bips, we don't know. The Bank of Canada people work with numbers, with data. It's not
With
like
data.
there is no
Yeah.
politics in it at all, right? Now, what's happening in US, okay, it affect Canada if there's something major. We're talking about tariff, right?
Yeah.
So if that tariff comes, it will impact the economy overall. It will slow down the economy. It will raise the inflation. See, so inflation, that's the indicator for Bank of Canada. They
Again,
don't look at the tariffs, they look at the inflation. Once the inflation has gone up, yes, now they have actually further cut, right?
Yeah.
Right? So this is how it works. Now, as a consumer, which way to go, right? So if you wanna link yourself to the fix, I'm not here to promote fix or variable. Fix is, as Reena mentioned, is kind of linked to the bond, right? The bond rate. And the bond rate goes corporate policies, global, where the variable goes linked to the inflation. It's more domestic things and more flexible. And we know that rate is getting cut. So you're gonna go down. But right now we're talking about the variable is higher than the fixed. Like what's a
Oh, I mean, it
what's
was
the
a
normal
lot.
rate
It was a
nowadays?
lot. So, like, you're looking at a 3-year fix. Let's say if you're putting 20% down, you're
Mhm.
looking at about 4.39%.
4.392. What's the range? Let's put the range here.
Yeah. So let's say 4.09 to 4.39 is roughly if you're putting less than 20%, and if you're putting 20% down.
4.39, like 4.4.
Yeah, 4.4
Which is
roughly.
4.4. I was talking to the banker today. She was saying 4.9. Anyway. So
No, she was probably referring to the variable rate. So you see the difference
So-
between the variable and the fixed is about 50.5 difference. It's not that much anymore, the gap between the two,
oh, I didn't know about
right?
that.
So if you're looking at the variable, you're looking at about 4.8 to 4.9.
so we're predicting
On
then
both.
somewhere the mid of next year the variable is going to be lower than the fixed, right?
It will. I mean, yes, based on if you're taking a fix today and where you want to see the variable, yes, by next year it should be trajecting.
I remember one thing: when you sign a contract 3 years variable, it's hard to get out of that contract in terms of there is a higher penalty. Now,
Variable does it.
Yeah.
3 months interest penalty.
yeah,
Yeah.
variable, but I'm talking about fixed.
Fixed has a
Okay.
higher penalty.
So now you are mid of 2025. You saw variable is going down and going down, right? And you say, I want to get out. So that's why I'm not here to give you advice. You decide by yourself, fixed or variable.
Yeah.
Okay. I know sometimes bank promote this or that, but that's and one thing to explain that.
It's based on your risk appetite,
Yeah.
whether you're okay with the increases and the decreases, and then the variable makes more sense with you if you want to bet on that, right? It's based on your long-term plan for your house, what you see, in terms of your appetite, and you're okay, seeing those
And your
decrease.
income, that's
exactly
very
your
important.
income.
If you have a
all that
steady
stuff.
fixed income's doing
You want
well, you can
Yeah.
If you
You
are
want
not
peace of mind, sleep at night, then
Yeah.
fixes for you. Yeah.
so one thing I want to explain to everyone is any interest rate. I mean, the interest you're getting, what you said, 4.5, whatever, it has a compound. The cost of borrowing, okay, which is where you go to the depositor and you pay them a deposit. Let's say, what's the GIC nowadays? 3%, 3.5. Okay, let's say that's a cost of borrowing, 3%, and they add up a margin in it. That margin, it's a bank margin. It's compound of two things: the cost of the bank to run the whole thing, we call the management cost, and the other part is a risk factor. Now, what happened back in 2008, if you remember, there was a credit turmoil, credit liquidity problem in the world. In a sense, unemployment, businesses were failing, no cash in the market, and what the bank did back then, I remember very well. I was a banker. That margin was really, really high. There was 300-400 points. I mean, if the deposit was at 2.5%, they were adding 4% on the top because the risk factor was high. Now, we do not know what's going to happen with the job market and the economy in 2025. If it shows risky market, don't expect, especially when you're coming to the fixed, the rate will fall really, really, really down. But variable is different story. Again, that's my experience I'm sharing here. I don't want to. I know this is a common question. Most of the people ask that. That's why I spend
Where
a
the
little bit more
rates
time.
are going. Yeah.
Spencer, anything more?
Bunch more questions. This one's from Salam. How about young professionals? People started a job only a year ago. How does the approval process work for first-time buyers who have 20% down?
I think
It's pretty straightforward.
We covered that
Yeah.
with the question came from Ali and Murad. Probably,
That's pretty forward. A year is a good gap in terms of starting your employment. Just also depends on whether you're full-time or you're self-employed. So that's where different rules come into place. But if you're full-time employed, permanent, then you shouldn't have any issues buying a house.
But again, she
You have to
mentioned young.
qualify.
Young, maybe the word young, maybe because of the income. The income, not because of the age, because of the income, maybe, unless you're making good money, right?
Yeah.
So you might need a guarantor or a co-signer, not a guarantor, co-signer who jump in. And when we say co-signer, people think like back out of Canada, like someone signed the paper, that's it. No, the co-signer is just someone has to submit the income documents. And
It's
they
the
have to be
same.
qualified, actually.
Yeah.
They have to be fully qualified. If somebody has a couple of mortgages, want to be co-signer here, you got to be, you have 4 mortgages or 2 mortgages. Can you co-sign someone else? It's like just rental, when a co-signer came, right?
Or
This is more
guarantor,
strict.
yeah.
So the bank, they will go into details of the co-signer as he's an applicant, and he's going to be on the title. Ali was asking for that, right?
It would be co-owner.
Co-owner, actually co-owner, co-borrower, co-everything, right? Another question, if you don't mind.
This is also from the same person. They were asking for newcomers requirements. I'm assuming for being approved for a mortgage.
Yeah.
For a newcomer to the country.
Yeah, so as long as you have, somebody that's new, it's a lot of issues for newcomers to Canada that I see, is typically that they haven't started to establish their credit, right? So typically you are still allowed to buy with a minimum down payment as long as you've had 3 months of history of employment, right? And in terms of looking at credit, if you don't have enough credit established, we do look at alternate sources, right? So someone, that's been renting, for, I don't know, the last year will ask you for rental payments as well as, landlord reference, or, if you're making timely payments on your utility. But yeah, you shouldn't, you shouldn't have an issue as long as, you have employment established for at least three months. And then credit sources, obviously, we look at.
And the definition of a newcomer is very vague, like very wide. Like,
Yeah.
is he a newcomer on a work permit?
Yes.
Is he or they are
Then
a newcomer on a visit visa,
Yeah.
work permit, refugee status, then PR? All of these are considered newcomer, and even
Yeah.
refugee. There is 2 status of refugee. There is refugee who applied to be accepted, and refugee who was granted an approval by the government. They call them protected refugee, something like that.
Mhm.
So there are different answers for that question.
Yes, and there's different
But
requirements as
yeah,
well, right? So
even the work permit, how long they're working and all of that, right?
Yeah,
So it's a
has to
really,
happen
really
already.
detailed. I mean, it needs a session. It's on
I
itself.
know. You can call me.
Reena's there always. You can connect with us
Yeah.
because honestly, there is no. We don't want to give you one answer, and we don't know what kind of newcomers is there. So it's
Yeah.
better to connect with Reena and ask specific, and she'll ask a question. Then we can get better answer. Any more, Spencer?
Yeah.
Are you looking on LinkedIn as well? Yeah.
I'm on LinkedIn and Facebook.
Thank you. I appreciate that.
One question on LinkedIn. When do all the new rules come into effect?
Okay. You want to do that?
Yeah, go ahead.
Yeah,
There are a bunch
so-
of rules, a different timeline, right?
So the insured, where you're allowed to put, the price cap increase from 1 million, under 1 million to under 1.5 million, and the 30-year amortization is coming into effect December 15th. The switch renewals, again, it's all lender dependent. A lot of lenders are still coming on board, but that has already been in effect since November 21st. And then the refinance, insured refinance, where you're refinancing to add an additional secondary unit. Correct.
Yeah, time home buyer. That's why we have this conference today, Q&A session. I'll try to put it on a screen as well here. I'm doing my best. So those what she mentioned, and people can visualize that. Yeah, go ahead.
Yeah, no, she mentioned something about the secondary suite.
Yeah.
There's a question about that too. What are the benefits and requirements for adding a secondary suite under the new rules?
So the benefit is, one, as a homeowner, you get additional rental income, right? So if you're living in a house, you have a basement that's not finished and you want to rent it out, the benefit of that would obviously be that you're able to refinance under this program, right, up to a higher loan to value to add that additional suite. Like I said before, like you can add up to 4 as long as you're occupying one of them. So that's pretty much the benefit under this program.
Will these changes affect property prices?
Ooh, that's your
Can
question,
I
Ali.
answer that? Absolutely yes. Absolutely yes. And of course, the city assessment as well. If you have a legal, you have to disclose it to the city, to the municipality, and the tax will go up. And that's another thing. Yeah, the value absolutely is going to go up. We are in a market. Most of us here, agent, when we see there is a property has a potential income in certain markets and certain price tag or the property value, it is very, very, very important. Believe me, we have buyers are looking for towns, which is really, really tight to have a separate unit to be rented out. But sometimes a $4 or $5 million house doesn't make sense. But yes, it is very important. It will increase the value, and the value increases, by the way, not by the amount of money you spend. If you spend 100,000, 50,000, the value might go to 300,000. Depends, too many factors. So for real estate perspective, yes, it does.
I think the issue is also supply. We have issue of supply, right? Adding a secondary unit, just adding to that as well, right? So,
So I'm putting the table here. This was the most important. I don't know if you move a camera a bit, so then can be seen, right?
I think you need, yeah, that's fine.
Yeah. I think the other camera is a bit like, or go, yeah. Any other questions, text or any question? Okay. Great, this is.
Yeah, there's a couple more questions, 2 more. I believe one was, what should I do to prepare for these changes?
Well, one.
As a
yeah.
buyer here? Okay.
Yeah.
Maybe as like a buyer or a homeowner.
Okay.
Yeah, so I mean, from a mortgage perspective, the first step you definitely need to start. If you're looking to buy, then it would be obviously to get pre-approved, know what you're qualified for, because I think even when you jump into the market and you're working with an agent, let's say like Ali, he'll want to know what's the maximum you can afford, right? So that is the very first step that I would recommend, is talking to mortgage specialist or an agent in terms of getting pre-approved.
Yeah, it's all about planning. First, from a real estate perspective, you got to understand from a professional. That's why we're holding this kind of conference, is to clarify live to the people that what is the real impact. So, and what, in simple terms, we're going to explain. We explain many things. So now you understand where you fit, because it's different from, are you an existing homeowner? Are you a first-time home buyer? Are you not first-time home buyer? What do you benefit from those rules and regulations? And so if you understand what the benefit for you and where you fit, now you connect with a realtor. I mean, I'm not here just to promote myself and the team and the brokerage. Any realtor you work with, you connect with the realtors. Now you understanding, because very honestly, we are a realtor in this industry. We don't know everything about the mortgage or banking or finance industry. I mean, supposed to be knowledgeable, to be very honest, up to a certain extent, having the knowledge, but we are not licensed to give an advice. Having the knowledge is a must, is very important. Licensed to give an advice, to give advice to you, you got to be licensed, and you need a mortgage broker or a bank and even when you go to the bank, I have a client recently was talking to one of the major bank, but he was talking to the financial advisor. The financial advisor, in my opinion, with all respect, they are just referral point. They don't know. You got to speak to the mortgage specialist. You need that title. Correct me if I'm wrong. You need that title in the bank in order to get the right question and answer, because they have the knowledge, they are licensed, they are trained, they know about their product. But the financial advisor or teller or anyone in the bank, they just referring you, and they're trying to give you an information, because this client was telling me I didn't get the good information and this and that. I said, because you didn't talk to the right person, right? So once you know that there is something new for you, you connect with someone, or you end from this conference, hopefully you get what you want. Now you connect with the realtor and move. In my opinion, I don't want to act as a salesperson here, but if you are a buyer or someone an investor, let's say, in other word, and you're ready, you have the appetite to jump into real estate, there is nothing better than now. Don't worry about the interest. It's going down regardless what's happening in south of the border, is not going to be that way you think, in my opinion. And Canada is a standalone economy, and we look at our own inflation numbers. We don't look at the neighbor's inflation number. We look at our own things. This is how the Bank of Canada reacts. It's not political. It's a bunch of people with economy, the highest economy degree, are sitting there and they're deciding. There's not a prime minister calling them or any other minister or anyone, hey, do this and that. It doesn't work this way in such economy, right? Any other questions?
Yes. Here's other questions. How do I know if I qualify for the new mortgage options?
The best place to start is obviously, see mortgage specialist or an agent, right? To see, what terms of your qualification is. And I guess we can, it's kind of hard to say right now because we don't have enough information, but yeah, that would be your best step to see what you qualify for.
Now you are aware something is happening starting from tomorrow all the way to January 15. Let's say you are not clear about that. You might think that benefits you. I would urge you right away, whether you call to your agent, but again, agent is not the source 100% of the information. Maybe your agent knows someone who is really good with experience, and this thing will connect you to, or approach a licensed mortgage broker. Like there's too many in the market. And keep in mind, when you go to your lovely branch bank, avoid anyone who doesn't have a license, like a financial advisor, even a branch manager. With all respect, they don't have the knowledge about the industry, and they give you something, vague, something not clear. It will turn you away from this opportunity. Try to connect to the mortgage specialist, right? Is that the title, mortgage specialist, right?
Yeah.
Someone who has a license within the bank, someone who's trained to give you the right things. And of course, you have in the market a lot of mortgage brokers. Reena's kindly one of them here today, giving a lot of information, been working for a while together, and she's really, really knowledgeable, and feel free to connect. So you need to qualify. That's the answer. You need your qualification in order to know what's the next move for you.
One more question relating to mortgage qualification was, how does the stress test for mortgage qualification get affected by the new rules?
Yeah, so like I said, the stress test still applies, right? It's anyone purchasing a home that has never purchased. The only time it doesn't apply, the stress test, is when you have an existing mortgage and you're switching your mortgage to a new lender. So if your renewal is coming up, right, then that stress test doesn't apply. So so anyone that's purchasing, it still applies to you.
Yeah, so they didn't remove the stress test yet. I remember
No,
there was
they
a lot of
haven't.
talk, push
No.
from the industry.
There's
We are
no-
stressed already. Why are you stress testing us?
Yeah.
And remember back in 2016 when they came with this stress test, it was the right move.
Absolutely.
In Canadian economy, and everyone hated the banks and, oh, these are crazy, you are so conservative, blah blah blah. But believe me, as a banker, I'm telling you, they did it right. Okay, they were seeing and projecting what's going to happen, and now at least we are not in a turmoil. We are not in big default and problem and everything. But hopefully they remove it soon, because the outlook is going down, so there is no stress, in my opinion. Once the outlook is going to be stress, when we hit the bottom, when we had I didn't think the mortgage rate was going to go less. I'm talking about variable, less than 3%, in my opinion, for the next couple of years.
I think pre-COVID, 3.5%, 3%.
3.5%.
What was the norm, right?
But
So
we might stay for 3.5 for a while. Then we might start to climb. The moment you you climb, the bank has to jump in again and do stress test. So they have to remove. But again, I'm not here a policymaker, but stress test still there. And the exception comes with the new rules for a stress test, is the one when you refinancing, going to another bank. But here is very important: refinance, not taking more money.
refinance is when you're making any changes to your mortgage. So either you're increasing your amortization from the original mortgage that you've taken, or you're taking equity out. Like, you want to do renovations, you want to use the equity for whatever reason, investments or whatever. You're changing the terms and agreements of your original mortgage, right?
Reena,
So-
if I have right now, I had started 2021 myself personally, and my amortization back then was 25 years, let's say, right?
Yeah.
Or maybe 30 years. I don't know, 30 years. Now, I'm a triggered variable rate, so I've been paying for the last year and a half just interest, big interest, and now I want to switch another bank in order to have back to 30 years amortization.
Yes.
Okay.
Yes.
So and of course,
then you would be
and not
stressed.
to do not do that trigger rate anymore, right?
Yeah.
Or maybe I go fixed, maybe I stay variable. My goal is to extend my amortization in order to lower my payment,
Correct.
right? Because with the trigger rate now, even the interest rate goes down. This is something we were talking multiple times. Your payment won't go down because you missed a lot of equity payment, and I missed a lot of equity payment in the last year and a half. So I will be continuing paying the same monthly payment to recover what I didn't pay. So probably till somewhere end of 2025, then the relief start for me. But if I'm intending to do that switch, would that benefit me? Like extend
your amortization. So that would still be considered a refinance, like I said, right? Because you're not keeping the amortization the same when you're switching. You're changing the term and of your actual original contract. So that would be considered a refinance. But you can do that. You can extend it back up to 30 years, right? As long as you qualify it, all that stuff. But then you would be again subject to the stress test.
Of course, yeah.
Yeah.
So that's another way if you are under stress right now already.
Yes, and it's a great way to do that as well. So somebody that wants that monthly extra cash flow with the added benefit of a 30 years, yes, you're paying extra interest over that additional 5 years, but every lender has prepayment privileges with your mortgage. So you can always use your prepayment privileges to, with the added benefit of still knocking years off your mortgage, but still have that comfort of that extra lower monthly payment.
There was a catch there. I remember when I was talking to my lender, they said you have to be 3 years paying in order for you to refinance if with existing lender. I remember that they told me, it said, oh, you are less than 2 years, something like that. We cannot refinance for you right now.
No, not necessarily.
2 years, it has to be within 2 years.
No, typically, there's not a timeline, in terms of
Depend on the equity, how much equity.
Yeah, if you don't have equity, then yes, it's a different story. Because you have to, in order to refinance, you have to be 80% LTV of whatever the appraised value is. If there's not enough, 20%.
80% the existing rule, but 90% now you said LTV.
That's only for insured refinance. That's separate. So that's only if you're adding a rental
not
unit.
insured, so.
Yeah.
Okay. Any other questions, Spencer, from your end?
What are the risks of choosing a longer amortization period as a first-time buyer?
So
Very obvious.
obviously the cost of borrowing is higher, right? You're paying more interest over that additional extra 5 years, right? But like I said, in terms of comfort wise, it does give you a lower monthly payment on that extra 5 years and that added cash flow. And you can still, make additional payments to your mortgage as long as it's under your prepayment privileges. That's allowed to counteract that basically.
Yeah.
And pay more into your principal and then less into your interest.
Yeah, the downside is the cost, but the good side is you have lower payment and your affordability will boost. You'll have
By
more
7% roughly.
by 7% roughly.
Yeah.
So yeah, but keep in mind that's something I want you to keep in mind as the homeowner. Barely I see people, they say 30 years paying for their home. They switch. You build an equity, you go to the next, whether you upgrade or downgrade, lifestyle change, especially if you are a first-time home buyer and you got now, you want to go from a condo to town, from town to detached and back from detached, maybe you downsize back to back to right? Or maybe exit, I don't know. So theoretically, you won't stay 30 years paying amortization,
And on average, a lot of people break their mortgages within the 5 year, like a huge percentage. So
What does that mean, break?
exit.
you're refinancing, you're breaking that existing mortgage, right?
Yeah. So let's say you build enough equity and you have a big detached house. Now you can downgrade. So you take that equity, you buy a cash, smaller house. So now guess what? You have no debt, right? Debt free. See, you build, you started, you have a detached, you build, let's say 700,000, 800,000, a million in it. Now you have that equity, but your house worth 2 million. So you sell that house, you bring the cash 1 million, and you put it in a town or a condo. Now you're debt free. So did you end up 30 years paying? No, maybe 10, 15 years. Depends on the market situation. That's why the timing is very important in real estate. When the market shoot up like 2 years ago was the best time to exit and cash out. Right now is not the best time. Right now is to acquire. In the future, hopefully the market goes really better than like 2 years ago.
Question is
Yeah.
relating to
Mhm.
timing the market. What steps should buyers take now to benefit from these changes in 2025? Should they delay purchases
Take the
or
phone
start
number, say I will call you
pre-qualifying
back.
for new programs?
Take their phone number. We'll call.
Ali?
Yeah, so take it's complicated a bit. So take their phone number, we'll call them from here. Yeah. Somebody's on the phone.
Ali, I
Yeah.
think that was question.
Sorry.
I'll reread it out.
Yeah.
Take the live one and then.
Well, no, go ahead. I'll do this.
Yeah,
and
so
call.
what steps should buyers take now to benefit from these changes in 2025? Should they delay purchases or start pre-qualifying for new programs?
I'll start with Reena here. Then I do real estate part of it.
I mean, that was a question that I'd asked Ali earlier. Do you think because of this increase in price cap, is it going to create more competition in that price point? Because before it was a barrier to entry. Like I typically always tell my clients, when you're ready, don't think about it, right? Make the move, get qualified, and get into the market, right? Because you can't time the market necessarily, right?
Yeah.
So, and I'm sure Ali
See,
can add to that.
We are salespeople in this business, and we are biased. Okay, that's what most of the people they look at us. So we want to do transaction right now and make money, right? But the thing in real estate, timing is the most important thing, right? Time. So in my own experience and my own the way I look at it. Now she said, you start right now because with rules and regulation, with interest going down from her point, from the banking industry point, she's right. From the real estate point is the best time. The reason why, because we see the interest rate is going down and we know the relationship with the interest rate and the value of the property is going up, and the rules and regulations. What are you waiting for? Are you waiting for the property price to go up? And everyone knows here, I did back then a calculation. Remember that calculator I did? So what I did, I calculated the variable interest rates for upcoming 5 years, and I put them aside. Then I calculated the potential growth of any property for the next 5 years based on the last 5 years history, and I stress it by 50%. Like if the growth for the last 5 years was 50%, so I took 50% projection. Always, whenever I go in the GTA, I'm talking about GTA here, I don't know about other places, I see the amount of growth, potentially grows, double the amount of the interest you're going to pay based on the variable interest rates, which is going down the road. So what are you waiting for? You're waiting to buy something growing and more expensive because you have to bargain. The market is going to be back to multiple offer, which is already started already marketing.
But I think it's still more of a balanced market right now. In terms
it is.
of,
See, right now, it's unfair to say all market is slow or all market is good. Depends on the pocket. What are you buying? Depends on the products. What are you buying? I see most towns nowadays are really crazy, right? I see some markets are really good. Some markets, for example, I see them very, very slow. I notice London, Ontario, for example, is very slow. I notice Thunder Bay is very hot. I noticed within GTA, for example, most of the GTAs are really, and product-wise, I noticed before we start, I remember some few agents, they were talking about condos as well, right? Condos are really still slow because of the supply and everything. And I think we called, they have the phone for the Murad? They have the phone number?
No, for what?
That
No, that's something.
something else. I thought somebody's calling and asking a question. Okay, again, the phone is 905-209-7400, the extension, whether 106 or 107. It comes directly to us. We pick up the phone and we can talk to you. Anything else?
There is how many more questions can you take?
Similarity, you see.
Popular.
So let's find out. I know we are above we said an hour and a half. We are going above and beyond because at the end I want to have a message for the realtors and for our industry before to go. and especially there's going to be in a minute. But are the questions similar or?
Yeah, they're fairly similar. There's three more left.
Okay, go ahead.
Yeah.
Cool. Is there tax implications for making a secondary suite?
That's a good question.
Well, are we talking about
Like-
property tax?
Yeah.
Of
I'm
course.
surprised.
When the
Yeah.
city knows about that, they will reassess
Any-
it,
yeah.
right? And the property tax will go up. Now, if you're talking about income tax, I mean capital gain tax, when you sell your house, of course the value is going to be higher. And remember that is part of your principal. So I don't think CRA will look at it like a separate unit to be taxed separately, like you're doing it for. And there are rules and regulations. You can ask your
Yeah.
accountant. Less than 2 years or 1 year, something like that. Yes, the property tax is the most important things. What's the ratio? How much this? I don't know. Depend on the assessment. And especially when you legalize it, the city would know and they will send you an assessment, which is highly recommended. Legal basement or a unit is very important in the market. It has higher value. You're on the safe side. Insurance. Some lenders are very, very sensitive to make sure that's legal or done in a proper way. And for safety. And rules and regulation is the most important. Yeah.
All right. Are there any regional differences in how rules will be implemented across Ontario?
No.
Actually, all Canada. Same
All
rules.
of Canada, because it isn't a government
to coast,
rule,
right?
right? So it's a federal rule, so it applies to all.
Yeah, the industry is governed federally, so it's a federal. Yeah.
Any impact on people buying rental properties?
Investors, you mean, right?
Yeah.
Yeah. So you mentioned, so most of the rules are not really on
They're
the
not
side of
related to any investors. It does not promote
Right?
investors.
So, but what is on the side of investors, put it this way, the interest rate cut itself, right? The interest is going down. That is really big. We haven't spoke about that 50 bips just a few days ago. That's really benefiting the investors. And remember one thing, investors are those people are buying unit and giving it to the rental. And there are a lot of rental out there. I know the rental is going a little bit down because the flow of migration and everything a little bit slowed down, but that doesn't mean it's going to stop or anything else. But still, investment is the way in real estate to build up your wealth and equity. Yeah.
Okay. Last question. How can someone get in touch with you too if they want to work with you?
Okay. Spencer, what's the best way? Can we post
Can
our
we put our
information down here,
information
or-
in the chat or something?
Yeah. Okay. Yeah. Remember, I'll talk about my brokerage, REMAX Success Realty. You can Google us. You can find us. We have a website and we have a phone number. I will repeat it: 905-209-7400. 905-209-7400. Whether you go extension 101 or extension 102, or if it's a call center, you ask any agents or myself or any agent to call you back. We can help definitely. I have an email. You can go info@remaxsuccess.ca. That's another thing. For Reena,
For me, I am part of Dominion Lending Center, so I do work for the broker side. I work with multiple lenders on my end. I've been doing this for 6.5 years. You can reach me at 416-561-2454. And we have offices all over Ontario. One's in Markham, one's in Mississauga. And yeah, just give me a call if you have any questions.
and our website is very important. We have a lot of experienced agents. Some of them are here today, and maybe you didn't see all of them. You can connect with anyone. I can guarantee it's a free consultation, no obligation to push whatsoever. The most important is here to get the right information from the right source, right? And take a decision based on that. And then you connect with our realtors, and hopefully the sales is going to happen. Any other questions?
That's it.
Okay, I'm happy. So
Alright.
one message before to go to the realtors in the industry. It is the right time to talk to your clients, mainly the buyer clients, mainly the first-time home buyer, because what you have here today, what is going to be tomorrow or December or January 15, all the way cater into the benefit of the buyers and first-time home buyer, right? Please try to make them, give them the education, give them the information is very important, and connect them to the right the right professional, like the mortgage broker. Reena is here, or a banker, any banker. Try to explain yourself. Let the professional do it. Investor as well, is a time to come back, because the question was asked, what is for the investor? What is for the investor? The interest. The interest is down. The value is going to go up. Don't worry about the cash flow. The cash flow is going to be positive once the interest rate is down, because the most important here is the interest was high, the cash flow went negative. I know the rents we're seeing, rent is going down. It's not going to go down significantly. It's going to down slightly and going to flatten. So in terms of rental, you won't have problem. I know rental tenants, sometimes there are problem and everything. Remember, this is another subject to talk about. There are insurance companies, they can insure your tenants. There are agents, or yourself, you do deep due diligence, you can secure it in that way. Don't be scared of tenants doing this and that, right? So that's the message to the realtors. Let's move. And at the same time, sellers, we are here not to ignoring the seller of the homeowner. Sellers, in the past a year and a half, Reena, they were really hesitating to put their houses in the market because disappointment. The price was down. It's nothing to do with the realtor, with the brokerage, anything. The market sell your house by itself. Right now, there is a lot of recovery. If you are stressed, whether you are an investor or you are a homeowner buyer, I don't wish any homeowner, to be honest, to sell because they are stressed. But you want to upgrade, you want to downgrade, you want to exit, whatever. It is the right time because it's growing. Yes, you can wait later on to sell, but there is a cost from now till let's say end of the next year, right? I always see the condo segment, for example, end of 2025 will come back to normal. Still not doing well. I'm not lying here, whether it's in Toronto or anywhere else. And again, depends on the pocket and all of this. But the single and detached market are doing it. A lot to say about that. That's what you need to connect ourselves in our brokerage. I post a lot of videos almost weekly. Spencer, I post about the market update and everything. You may follow up and find out what's happening in the market. If you have any specific details, you want me to talk about your market, about your own, let's say you have a semi, you're living in Mississauga, Churchill Meadows, you want me to talk about that, there is something called month of inventory. I can run that calculation specifically for you and your people in your neighborhood and give you information. That's my message. Thanks for today. I'm happy. We are a little bit like above the time, considering we wasted time at the beginning with
That
technical
means it's
issues.
great, right? So
That's really good. Thanks for Reena.
Oh, you're very
Huge
welcome.
thanks.
Thank
Really,
you
I
for having
appreciate
me.
in a short notice you jumped in.
Thank
Right?
you.
I appreciate that. That's a benefit having someone like Reena around us all the time. Thanks for our realtors, our folks here in the brokerage here, or in the studio or a newsroom, whatever you want to call it. Thanks for our audience, whether they are on LinkedIn platform or on a Facebook. And we'll try to record this. Definitely, we're not trying, and we'll share it with everyone. We'll post it on our platform, so if somebody missed this opportunity, they can listen to what we said. Again, we would love to connect with the people. There is no pressure, no sales here, whether from my end or from Reena or any of our realtors. Just go to our website, remaxsuccess.ca. You will see all kind of realtors. Pick and choose. All of them equally good. If they miss something, believe me, they come to me, they go to Reena, they go to their banker and mortgage, and they're really, really helpful. We are here not trying to pitch to sell. We are here trying to help the consumer in the market to have the right knowledge and take a decision by themselves. Thank you today again, and I wish you all the best.
Happy holidays.
Happy
ahead of
holidays, good
time.
weekend, and happy real estate and successful one, right? Thank you. Bye for now.
All right.
Can I see that form, the interest rates?
Do you want me to send it